A cybersecurity company once caused the biggest technology outage in history. Not a hacker, just its own software. Airports stopped boarding, hospitals switched to paper charts, banks froze mid-transaction. One airline alone said the 5 days that followed cost it $500 million, and it sued the company that broke its systems. Stay with me, because what happened to that company next is not what you'd expect. If you've ever wondered exactly who gets paid in cybersecurity, and for what, this is that story. Okay, so, start with what this business actually does, because the name hides it. What a cybersecurity consulting firm actually sells is a professional judgment call. Here's where you're exposed, here's what it would take to break in, here's what to do about it, and here's a signature saying you did it properly. That judgment gets delivered a few different ways. A red team, paid to actually try to break into a company's systems the way a criminal would. A compliance audit, checking a company's defenses against a regulator's checklist, or a team that gets called at 3 in the morning, after the break-in already happened, to figure out what got taken and how to stop the bleeding. Different names, same underlying product, somebody trustworthy enough to be believed, telling a company the truth about its own risk. Nearly anyone who runs anything digital is a potential customer, which sounds like it should make this an easy business. It doesn't, because the entire market runs on a single scarce input, and it isn't money. It's trained people. Building a real security team from scratch means hiring people who understand how attackers actually think, and there are nowhere near enough of them. One estimate from the OECD put the global shortfall at more than 3.5 million unfilled cybersecurity roles by 2026. That shortage is the entire reason the consulting model exists in the first place. A smaller company can't easily hire, train, and retain that expertise in-house. The talent is too rare, and the people who have it can get hired away in a single phone call. So instead, it rents the expertise by the project, from a firm that spreads the cost of employing rare people across many clients at once. Research cited by industry analysts found smaller businesses are roughly 3 times more likely to hire an outside consultant, rather than build a team internally, for exactly that reason. The scarcity of the raw material, trained people, is what manufactures the entire consulting industry sitting on top of it. That scarcity also explains why one small country punches so far above its weight in this industry. And it's worth understanding why, because the story runs through a military unit, not a business school. Israel's Unit 8200 is a signals intelligence branch of its military. Young recruits, some barely out of their teens, spend years learning to break into and defend digital systems, at a level most people never touch in an entire career. When they leave the military, a striking number of them start companies. Alumni of that single unit have founded or led firms including Checkpoint, CyberArk, and Palo Alto Networks. And Wiz, the company Google agreed to buy for $32 billion in 2026, the largest acquisition in the history of the cybersecurity industry. Nearly half of the country's cybersecurity companies that sold for over $100 million in the past decade trace back to alumni of that one unit. The lesson generalizes past this one country. When a skill is genuinely scarce, whoever controls the pipeline that trains it ends up controlling something much bigger: a military unit, a university department, a single elite employer. Whichever it is, they end up quietly holding a disproportionate share of an entire industry's value, long after the people involved have moved on to something else. Keep that idea in mind: who controls the pipeline? Because it shows up again, in a very different form. Once the money leaves the physical chain entirely and moves into finance, here's where the real smeckery of this business lives. The part most people watching a headline about a data breach never actually see. A cybersecurity consulting firm's report doesn't just tell a client what to fix. Increasingly, it's the document that decides whether that client can even buy insurance. Global spending on cyber insurance premiums reached roughly $16 billion in 2025, nearly triple what it was 5 years earlier. The way insurers price that risk has changed right along with it. It used to work like a form. A company answered a short questionnaire about its defenses, an insurer took its word for it, and a policy got issued. In the past couple of years, insurers started running their own outside scans of a company's systems instead, requesting evidence, not promises, and in a growing number of cases, they won't bind a policy at all, not until a third-party audit confirms specific defenses are actually in place, often performed by exactly the kind of consulting firm this video is about. Walk that all the way down to what it actually means. The insurer is offloading the hardest part of its own job, figuring out whether a company is genuinely safe to insure, onto a consultant it doesn't employ and doesn't fully control. The consultant gets paid by the company being audited. But the real customer for that judgment, in a sense, is the insurance industry sitting behind it, deciding who gets covered and at what price. Get flagged as high risk, and a company's insurance premium can jump by 40 to 100% at renewal, or the policy gets declined outright. That signature at the bottom of a security report has become, quietly, a financial instrument in its own right. That's one river of money running on top of the visible one. There's a second, and it runs through a completely different kind of buyer, not insurers, private equity. Cybersecurity, as an industry, is unusually fragmented. Hundreds of vendors, each solving one narrow slice of the problem, most of them selling subscriptions that renew automatically, whether or not the customer even remembers signing up. To a private equity firm, that's close to an ideal target: recurring revenue, high switching costs once installed, and a customer base that keeps growing because attacks aren't slowing down. One firm alone, Thoma Bravo, has quietly built a portfolio of cybersecurity companies, worth more than $60 billion in combined enterprise value. Names like Sophos, Barracuda, Proofpoint, SailPoint, and Darktrace. Buying founder-run or newly public companies, merging their back offices, trimming duplicate costs, and either holding them for their steady cash flow, or eventually selling or listing them for a large multiple of what was paid. One earlier deal, built by combining two smaller finance software companies the same firm had acquired, sold to NASDAQ for $10.5 billion. None of this shows up in a headline about a data breach. Consultants get paid to assess risk. Insurers get paid to price it. Private equity gets paid simply for correctly identifying that a fragmented, recurring revenue, non-optional industry was undervalued, and then patiently buying up all the pieces. None of this money moves without a third force pushing from outside the industry entirely. The law. A huge share of demand for cybersecurity consulting doesn't come from companies deciding on their own initiative that security matters. It comes from governments telling them they have no choice. The European Union's NIS2 directive tightened breach reporting rules for critical infrastructure operators across the continent. By one industry estimate, nearly 9 in 10 organizations affected expect they'll need to raise their security budgets just to comply. In the United States, a rule called CERCIA is set to impose a 72-hour reporting window after a serious incident. And several states, including California, added mandatory annual cybersecurity audits starting at the beginning of 2026. None of these laws mention consulting firms by name. They don't need to. Every new reporting deadline, every new mandatory control, every new audit requirement is, functionally, a new item on a checklist. A company either builds the expertise to check it off itself, or pays someone else to check it off for it. A regulator writes a new rule in one country's capital. A few months later, it turns into a wire transfer landing in a consulting firm's account, with nothing but a law connecting the two. That's about as close as this industry gets to a guaranteed self-renewing revenue source, one that isn't even tied to whether attacks are actually increasing at all. That regulatory tailwind is specific enough, in places, to build an entire small business around a single checklist. Consider the roughly 300,000 companies in the United States defense industrial base. Everyone from a 20-person machine shop to a mid-sized engineering firm, all of them now need a cybersecurity certification called CMMC, just to keep bidding on Department of Defense contracts. Most of them are far too small to hire a Big Four consulting firm, and the credentialed assessors qualified to certify them are scarce. Fewer than 100 authorized assessment organizations exist to serve roughly 80,000 companies that need the program's higher certification tier. A bottleneck deep enough that some contractors are already losing bids, simply because they couldn't get an assessment scheduled in time. That's the gap. Too many companies needing help, too few certified people able to give it. It's exactly the kind of opening a small, specialized consultancy can build a real business around, with a single regulatory framework as its entire reason for existing. It isn't guaranteed money forever either. Regulators can pause as easily as they mandate. The Department of War froze the next phase of CMMC's rollout in the summer of 2026 for a review. A reminder that a business built entirely on one regulation's timeline is also exposed to that regulation's politics, which brings the story back to where it started. Because the CrowdStrike outage is the cleanest illustration of how much trust this industry runs on, and how expensive it gets when that trust turns out to be misplaced for even one day. On July 19, 2024, CrowdStrike pushed a flawed update to its own security software. At the time, it was one of the most valuable cybersecurity companies in the world, protecting systems for a huge share of the Fortune 500, crashing roughly 8.5 million Windows machines, taking an enormous share of the world's infrastructure down with it. With no attacker involved, anywhere in the chain. Insurers estimated Fortune 500 companies alone absorbed roughly $5 billion in direct losses. And because so much of that fell outside the narrow terms of most cyber insurance policies, the majority of it went completely uninsured. Delta Airlines said the 5 days of disruption cost it $500 million and sued CrowdStrike directly. So, remember that question from the start of this? What happened to the company next? Its stock dropped hard in the immediate aftermath, then spent the next 2 years climbing back past where it started, and well beyond. The mechanism protecting it wasn't public relations, it was switching cost. Ripping out a security platform that's embedded across an entire company's infrastructure is already a massive operational risk. Doing it in the middle of a scandal makes it worse. Switching to a competitor's system, on top of that, makes it worse still. And most large customers judged that risk to be worse than staying put. Worse than demanding better testing procedures instead. Being essential, it turns out, can survive being embarrassing. Compare that to a company that had almost everything CrowdStrike's failure proved doesn't actually matter most. Pedigree. IronNet was founded by a retired 4-star general who had run the National Security Agency, backed by well-known venture firms. It went public at a valuation of $1.2 billion. 2 years later, it was gone. And the cause was almost embarrassingly mundane. IronNet ran out of cash, while demand for cybersecurity kept exploding all around it. Government clients overseas were slow to pay their invoices. Receivables piled up faster than bills came due. The company fell behind on an $18,000 payment. Amazon Web Services cut off the servers its entire product ran on. A company once valued north of $1 billion lost access to its own product, over a bill smaller than a used car. The lesson isn't really about cybersecurity at all. In a growing market, having the most respected name in the room protects nobody from a basic cash flow problem. The industry rewards trust. It does not forgive bad collections. Not every threat to this industry's revenue comes from outside it, either. Some of it is coming from a completely different business model, competing for the exact same dollar. The traditional version of a security consulting engagement looks like this. A client hires a firm. A small team of specialists spends a few weeks testing the client's systems and hands over a report. It's thorough, but it's also slow and expensive, and it only reflects what that one team happened to find in the time they had. A newer model, run through platforms like HackerOne and BugCrowd, throws that structure out entirely. Instead of hiring one team, a company opens its systems to a global crowd of independent researchers and pays only for results. A confirmed, working vulnerability, priced by how serious it is. HackerOne alone paid out roughly $81 million to researchers in a single recent year, and some of its clients now run continuous, always-on testing programs instead of a once-a-year engagement. For a company buying security, that's a real alternative to the traditional consulting relationship. Thousands of specialists testing continuously instead of 5 people testing once. For the traditional consulting firm, it's genuine competitive pressure on the old model. And for an individual with real skill, someone with no interest in working for an agency at all, it's also a direct answer to a question a lot of people watching this probably have. How would somebody actually make money in this space without a consulting firm's name on their business card? Find a real working vulnerability, report it responsibly, and a company pays for exactly that. No client relationship, no firm, no overhead. Just the finding itself, priced on its own merit. For anyone whose interest in this leans toward investing rather than hacking, the exposure is public and fairly easy to find. Cybersecurity-focused funds hold baskets of the publicly listed companies actually selling into this demand. They trade under tickers like CIBR, Hack, IADAC, and Bug. Names like Palo Alto Networks, CrowdStrike itself, Fortinet, Zscaler, and Okta, near the top of most of them. None of that is a recommendation. And a fund's price moving on a headline about a breach doesn't mean the underlying business got better or worse. It just means the market is pricing in more or less fear. It is, however, a real and existing channel. Somebody with no cybersecurity background at all is already, structurally exposed to whether this entire industry keeps growing. Zoom out, and the growth story is real. Even if the exact size of it depends entirely on who's measuring. Estimates for the global cybersecurity consulting market this year alone range widely. Anywhere from roughly $16 billion to over $45 billion, depending on what each research firm counts as consulting versus adjacent services. A reminder that market size numbers in a fast-moving industry are usually closer to an informed guess than a fact. What's not contested is the direction. Double-digit annual growth, driven by 3 things pulling the same way at once: attacks getting more frequent and more automated, regulation making security non-optional in more places every year, and a talent shortage that keeps making the outsourced version cheaper than the in-house one. What could genuinely slow it down is less obvious, but real. Artificial intelligence is already automating some of the lower-tier assessment work that used to require a junior consultant's billable hours, which could compress the bottom of the market, even as the hardest, most senior incident response work keeps growing untouched. And the private equity consolidation described earlier cuts both ways. Fewer, larger firms controlling more of the market could eventually mean less competition and higher prices for clients. Or it could mean a handful of dominant players squeezing margins hard. Hard enough that small, specialized boutique consultancies become the more attractive way in. For anyone starting from scratch, with nothing but real expertise, and a handful of clients. Every part of this is really the same story, told from a different seat at the table. The insurer who won't write a policy without a stranger's signature. The general who couldn't out-prestige an unpaid AWS bill. The teenager in a military unit who ends up founding a $32 billion company. The crowd of anonymous researchers, getting paid the same as a consulting firm for finding the exact same bug. Nobody in this industry is actually selling security. Nobody can promise that. And the ones who tried loudest usually end up becoming the case study. What they're actually selling, at every layer of it, is somebody else's confidence. That the risk has been checked by a person who knows what they're looking at. Oh, that's a strange thing to build a multi-billion-dollar industry on. It's also apparently one of the more reliable ones there is.